Hey guys, how you doing? This is Tevin from Simple Forex Options. As always, it is an honor to be with you guys today. I'm going to be making a part two, actually showing you guys. This is a continuation of the last video I made talking about which Forex pairs should you trade. I kind of realized that, of course, in the last video I gave good explanations, but I wanted to show you guys through the charts and kind of expound on not only what I was talking about yesterday, but more so expounding on how you guys can actually spot which markets you want to trade and which markets you should not trade. So that's something to keep in mind when we're assessing these pairs, because a lot of times people can blindly just trade markets based off of what people are telling them and based off of all of different market sentiment, but it doesn't necessarily mean that that's the way that the markets are going to go. So this version of the video, I kind of plan on making a little bit more of them, but this version of the video is I'm going to show you guys some tips of what I use to be able to assess my charts that will let me know whether or not I even want to trade a pair or to even consider trading a pair in the first place. So let's go ahead and go through that. Now, first off, what I have pulled up for you guys, this is the Euro USD. And of course, when it comes to making a decision about how you trade, it's all contingent upon how long your trades are planning to last. So if you're a Forex trader and you want your trades to last a pretty long time, of course, you want to use a time frame that's higher than the time that you're looking for your trades to expire in. So I mean, unless you're holding trades for a year, I highly don't suggest using a monthly time frame. The highest time frame that I use is actually weekly, and that's mainly because our trades tend to last several weeks sometimes. So sometimes they'll last 3 days, 4 days, 2 days, 1 day, and all the way up to like 2-3 weeks sometimes. Max, I think the longest one we've had was probably about 2 weeks and a couple of days. So that's always something to keep in mind when you're assessing your pair. You want to make sure that your time frame is suitable for the pair that you're trading. But not only that, I want you guys to actually pay attention to market patterns. And I'm not talking about in retrospect to trendiness, but I'm talking about in bar to bar market patterns. So if you were to look at, let's say that we check out, this is the Euro USD, and I want to put a little bit of color on this so it can look a little bit better. Let me see all of those. So let's try this out. Let's try to bar up. Let's get that with like a green outing, and we'll probably keep that black. Well, it's probably look good. Let's see how that looks. All right, I need to put something darker on those white bars. Okay. So yeah, keep that one black. I think that looks a little, well, that still looks kind of crappy. I guess we just change it right back to normal. I know what I'll do. I'll just change the background just to kind of give it a little bit more, make it a little bit easier to see. That might work out for us. There we go. So what I was more so referring to is that you always want to make sure that you are getting a time frame, that one of your charts is a time frame that's higher than the time frame that you're expecting to finish. So for example, if you are taking trades that are 5 minutes, you want to have charts that you can look at that are about 30 minutes so that you can have an idea of what the overall trend is looking like. So since I'm looking at these charts, these are week-long charts. And let's say that my trades are, I'm expecting them to last a day or daily type trades. I'm able to look at these charts and see, if they're trending, if they're not trending, and whether or not I even want to trade that pair in the first place. So I'm kind of go you guys through my assessment. So if I look over here at the beginning side, we can see that this pair is actually having an uptrend over here. And these are weeks, so just keep that in mind. We can see that the pair is having, let me get another one. You can see that the pair is having a downtrend over here. And if you get another one, you can see that the pair is having an uptrend over here. And you see that if you get another one, you can see that the pair is having a downtrend over here. So of course these lines is like extremely long. This is not the normal lines that you would use, but these kind of give you a good idea of where the market is going. And because you are looking at a higher time frame, you are also helping yourself out because you will only trade in that direction. It doesn't matter what it looks like. It doesn't matter if there's up bars or whatever it may be. You always trade the direction of the trend. If you lose, then you lose. But you always want to go on this side to where it's most likely to continue going. So if I were to look at these three bars and I say, okay, this is a downtrend, and when I see that downtrend, I'm automatically going to assume that the markets will continue to go in that direction unless it gives me proof that it will do otherwise. So that's something that you guys definitely want to keep in mind. Also, what you also want to do, and what you need to make a habit of, is that you have to look back at the history of the charts to see if this pair is actually used to holding trends. Which means that if a pair is not used to holding trends, then it's not something that you necessarily want to trade. Like, I can look back at the charts and I can see, okay, there was a definite uptrend that we see right here. I can also look back and see there was a definite downtrend that happened for 1, 2, 3, 4, 5, 6, 7, 8, about 8 weeks. And then I can look over here and see that there was a definite uptrend that happened for a couple weeks too as well. If you are always getting in on the side of the trend, even if you may have some losing weeks, you will always come out with profit more often than not. So that's something to keep in mind. So when you assess the history of these charts, you're able to see, and I kind of moved them over a little bit, but you're able to see that this pair is a trending pair, or has been trending for the past couple of months. In this scenario, of course, it'd be different for another scenario that you use. So because you're able to see that, now you can assess the volatility of the pair. And this is probably the most important one, because this will let you know what your stop loss should be like and what your take profit should be like. So let me go ahead and move this, get these off of here, because you guys already saw that this is a trendy pair. Okay. Sometimes MT4 can be a little difficult. So what you want to do is you want to assess the volatility of the pair. So, all right, this is what I usually like to do when I'm trading, and this has helped me so much. Now, if I'm looking at this pair over here during the flat times, what I can see is during these flat times, there's a lot of volatility going on. But when I look at the past trends, I always look at the spikes that is opposite of the direction that I am looking to get in at. So for example, if I am looking to get in on an uptrend, I always look at how did these markets respond going against the trend within this week. So right here, you can see that there was a pretty long spike. This one was about 50 pips. Well, about 60 pips. This one was about 60 pips. This was the longest down spike on an uptrend bar for this week that we actually saw, including this one too as well. This one was about, let me see, that was roughly about 100 pips on that one. But one thing you want to look for is you want to see if there's an overall huge spike on the bottom of the bar. If you see that there's not an overall huge spike on the bottom of a bar, it's helpful for you because you're able to get your stop loss above those areas. So for example, if I'm looking at this downtrend and I see, man, this has not been spiking up much, you see a little small wick right here on the top, and all this wick is just showing a high, or the wick show a high or a low that's past the open or close area. So as you guys can see, this is a very small wick. This is a very small wick. The very next week, you had a very strong spike down, which is still going in a direction, but it ended up coming back, but it didn't produce a wick at all. It didn't actually go past its beginning price. As you guys can see right here, this is a very small wick too as well. And then you start to see the wicks, they start to get larger. Of course, you see one large one. This is a spike up and down. Then you see this one, very strong spike down, very small wick. And then the wick starts to get larger progressively. You start to see a little bit more of them than you did earlier on in the trend. Now, that's a sign that you guys want to keep in mind. That's a sign that the markets may be trying or attempting to change, mainly because it's giving such strong pullbacks, ones that it wasn't necessarily giving before or earlier in the trend. Now, because it's giving those like strong pullbacks, and I usually, because I'm trading, usually I use daily charts, weekly charts, and 4-hour charts. I usually watch these wicks on the daily charts, really. I don't always watch them on the weekly charts, but they're still useful. So if we were to go over to the daily charts, what you guys want to look at is you look at the what I would like to look at is I always look at the longest wick that has happened within that respective trend, and I kind of try to base my stop loss off of that and my entry off of that. So if I see that this is an uptrend that's starting to happen, and I see, okay, this wick, this was a very long wick for a daily time frame. This is not weekly; it's just one day, and you guys can see it went from 1508, 15100 to 15600, which is about 500, 50 pips. So when you're looking at this is about 50 pips, you know that this wick is unlikely. This is not going to happen every single week, every single day during an uptrend, which means that if you were to get in on the next bar, the next candle, you would probably be okay with the 50 to 60 pip stop loss, and you will be able to get away with that if you're correct about the trend. If you're not correct about the trend, it doesn't matter how far your stop loss is, the markets is going to go against you anyways. But a lot of times when people would choose their pairs, they don't always take into the fact that a lot of pairs have a lot of drawback before they actually continue to go forward. So I'll show you guys a prime example. Let me see if I can pull up some different kind of pairs for you guys. Now you can see this Euro USD is a slightly wicky pair. So it's going to give you a lot of wicks. Most of the JPY pairs will give you a lot of wicks too as well. As you guys can see, this is a very wicky pair. It gives you a good amount of wicks, gives you a good amount of pullbacks. As you can see on every uptrend, you had a pretty strong pullback or a pretty strong pull down for this pair. And the same thing over here. Well, these 2 days they didn't have it much, but they had them all pretty much all of the other days after that, which that's communicating to you that more often than not, you're going to get a pullback against the trend direction with this pair. And because you're going to get a pullback against the trend direction with this pair, you want to make sure that your stop loss is pretty large. Now, if you have a pair that it doesn't give rarely any pullbacks or any strong pullbacks, it's a good thing for you because you don't have to have these crazy stop losses. You can kind of keep them at tighter or at bay. So the AUD USD is a slower moving pair, but I'm not sure that it keeps its, I'm not sure if it's not wiki, so we'll look at that. Prime example, this is perfect. If you look at the AUD USD, you see that there is slight wicks, but these are in sideways markets. But if you look, as the downtrend starts to begin, you start to see this wick start to get smaller and smaller. There's one huge wick right here, but after that, it's smaller. It's a little bit bigger, but this is small. And as you can see, they are very tiny. So if I was to get in on this pair, I would be able to actually take advantage of this for a sell option and still having a fairly tight stop loss that would be pretty much outside of a range of the wick. You see what I'm saying? So right here, let's say that this was a strong spike, and we're looking at this from 0.7565, and this spiked all the way up to 0.76 100, which that's technically about 50 pips. Now, in my signals group, our stop losses is about 50 pips and our take profits is about 150 pips. But we do that so that we can make 3 times more than we lose, which is always good to have a good risk to reward ratio. But as you guys can see, this is a very strong, very strong back spike, which means a very strong spike against the trend. The odds of this happening all throughout these bars is very rare, which means that if you can look at this and say, okay, this spiked up 50 pips and that was a very strong spike in comparison to all of the other candles during a trend, then now you can take advantage of that by getting your stop loss a little bit out of that range. Now, if that spike back was to actually happen again, then you would be pretty much in a place to where, okay, that was a strong spike back, happened again, there's nothing I can do about it. But if you are in on a trendy pair, let's say that you get in, you see the strong spike back on this day, right? And let's say you actually get in on this pair in this day. Your stop loss will be somewhere close to up here. If you guys actually go on my website or go on my Facebook page, you'll actually be able to see the past signals that Simple Forex Options has actually taken. And you will notice that those signals rarely ever get close to the stop losses. Now, the ones that hit the stop loss, they actually hit the stop loss. But the ones that are winning signals, you see that they don't even get close to the stop loss sometimes. And it's mainly because I try to position them in such a way that I know for a fact that if this is a true downtrend or if this is a true uptrend, the markets will have a hard time reaching there. So that's the one way that you want to kind of assess this. So if you look right here, you see that this 50 was a strong move for this pair in itself. You can, on your next candle or even on the opening day, you could get in on this one or get in on that one. What you'll notice is you'll have your stop loss somewhere up here, which means that if this stop loss doesn't get hit in this next day, and this is a trending pair, that by the time that pair gets down here and all of these little areas and whatever like that, that pair is gone. The odds of it coming all the way back and coming up here it'll be due to a trend change, or it'll be due to, it's sitting there for a while. And that actually has happened to us just this month alone, mostly because, our signals are a little bit slower. I need to speed them up because we're going into summer. So I know how the markets kind of slow down a little bit, but we did have pairs that were very strong winners, and then they end up coming back losing, but it's only because they couldn't reach as far as what we were asking them to. And it's only because the markets are starting to slow down during the summers, and the trends end up changing at that time. But our direction was correct, and the stop loss, the timing that we had was correct, and the stop loss would have never been touched had we had a good idea of the market volatility during this time of the year. So it's something to definitely keep in mind too, because the time that you're trading does matter. Markets do slow down severely during the summer because it's people's vacation time, off time. People are not trading as much as they usually do throughout the year. And because that's the case, you have to trade pairs that's a little bit more moving or volatile in order for you to get those kind of take profits that you're looking for in the time matter that you're looking for them too. So as you guys can see, you always want to check the wicks of the candle, and that's what I do too as well. It's very basic, very simple, but it helps me to be able to alleviate bad decision making and also to make better decisions. So let me show you guys, see if I can find you guys another charts that has low wicks. Now, prime example, look at this. The wicks on this one is fairly strong. You see a good amount of them. This right here, you see strong ones. You see a couple of strong ones right here, strong ones right here, over here. See some strong ones. This one, like if you look at this whole thing of candles, right? There's only one of these candles right here in this little downtrend. There's only one of these that actually did not retrace back. Every last one of them gave a back retracement as if it was going to continue in an uptrend. Like if you look at this, this would look like it will continue in an uptrend if you actually saw it spike up. Same thing with here. You see spikes up and then comes back down. This covered the whole body of the candle that was before it. Same thing down here. And this was a small wick, but this one right here was a pretty large one too as well. And then as the markets kind of destabilized, although this is a downtrend, this is what most people miss. This is a downtrend. This is a very strong downtrend at that. So if you had got in here, you would have been able to take advantage of all of this profit that happened during this time. But the thing is, if your stop loss was not set properly, then you would have been, shot in the foot. So when you are trading certain pairs, your stop losses or your entries have to be based off of the strength or the odds of that pair having to spike back and hit your stop loss. So I'm trying to find a pair that is relatively smooth. Most JPY pairs are not smooth. So that's something to keep in mind. Give me 1 second. Let me check that one. This one has a good amount of pullbacks on both sides, the entry and the exit. Usually Euro GBP is smooth. Look at that. Man, this is crazy. Now you guys see this. Markets like this that looks like this should never be traded. Not until they actually stabilize themselves. I can't believe actually people trade stuff because of the name, but as you guys can see, look over here. You look all the way back here and you look all the way up there here. You're like, dude, this pair has no sense of trendiness right now. And even when you look at the previous trends that it had before, it had such volatile or strong pullbacks that it's not really a true trend. You pretty much be running into your stop loss getting hit every other now and then you realize it's just not even worth it. But pairs like this, you shouldn't really mess around with stuff like this. This is not tradable, or it's not trendy at all. JPY is a very volatile pair. Although it doesn't look like it, it's a very strong moving pair. A small wick on this will probably be like 50 to 100 pips. So that's just something you definitely want to keep in mind with that. And most of you think I'm playing, but look at this right here. This is considered a small wick. Not super small, but it's a pretty small wick, right? It starts off at 145.51. I'll say 145.50. Look at where it ends up at. That's close to 145, 145, 670. So it's pretty much about 150 to 170 pips, and that's just in that small wick alone. So if you had a 50 pip take profit with this daily chart or this daily time, you would have to be extremely accurate with how you make your decision. Your margin for error is so small, and you'll be able to get a profit out of it possibly, but then you also too you run the risk of having a stop loss to be hit in just a zap like that. And that's why in my last video I always talked about the kind of pairs that you trade. You want to trade pairs that are not strong, crazy moving pairs that's going all over the place. The stuff that you want to stick with is you want it to be smooth, you want it to be mellow, you want the trends that when I look back at a chart, I'll always look at how previous trends performed before I get in on a new trend. So if I see that every single last trend before the one that I'm at now has ended early, or something crazy has happened, or it was abruptly stopped, I won't get in on it. And the reason being is because I don't have any valid proof that anything will stop that from happening now. So it kind of keeps you out from, making bad decisions or whatever. So let's go ahead and look at this one. This one has some pretty strong wicks too as well. Not as bad as the other one, and let's look at this one. This one has stronger wicks, the NZD USD, when it's in that mid-range area. But as you guys can see, as the downtrend goes down, you start to see a little bit less of those. But I think that if you get in on the right ones, you'll be able to get your stop losses outside of that respective pullback area, because that's the one thing you do want to avoid. So USD CAD is a very trendy pair. Now this is one of my very favorite pairs to trade. Lately it's been kind of acting funny, so I haven't traded it in a couple of weeks. But if you guys look at this is a very trendy pair. If you guys look at the USD CAD, you see that this trend is lasting from over here all the way up into here. You have about slight pullbacks, slight, relaxation times, but majority of the time you are looking at a very strong trend. If you notice, the pullbacks on these are so small. Look at that, so minute. And you see a couple large little things right here, but then they get right back small. And then you see another large one, get right back small. There's no pullback on that one whatsoever. All of these small wicks. This is an ideal pair that you should trade. And the reason why I say that is because you know for a fact from looking at it that you're not going to get crazy pullbacks and crazy stop loss triggers. But not only that, you're able to rely upon the trend and actually let the trend take you where it needs to go. So if I was to zoom this out a little bit, you actually be able to see that this pair moves a little bit smoother than some of the other pairs that we've seen. So if you look over here, you see, or let's start over here, you see down here, bam, it had a downtrend, which has started back up there. Had a downtrend. This downtrend went on for a couple of days, couple of weeks actually, came all the way up into here, and then they have a small, but these are still trending. Although they're small trends, they're still trending for like a week or 2 weeks or whatever. So you still see this, bam, still trending, like all of this stuff still trending, bam, and then you have a nice large one, and then it shoots back up, then you have a nice large one, all of that kind of stuff. So that's why I say it's always best to keep that in mind, the wicks and the smoothness and the trendiness of the pair. I don't even mind that a pair moves a lot of pips within a day, although I don't recommend it, but I'm not completely like against the idea. I'm more so against trading with pairs that I look at them and I see clearly that they are volatile and that they are going to hit a stop loss at any given moment, and it's nothing I will be able to do about it. So it's always something you want to keep in mind. USD Chef, look at this, very beautiful, man. This is, and I'm not talking about this part over here because that looks good too, but look at this. You have two little long wicks, but as you can see, they progressively get smaller and smaller. You don't have to worry about any crazy stop losses on this right here. What this things is communicating to you is that this pair is somewhat trustworthy, that you can have a moderate to small stop loss in and probably get away with it. So as you guys can see, during this uptrend, it was very strong. Then you have another downtrend. Then you have another uptrend, minor. And now you have another uptrend that's actually starting or taking place. So definitely something to keep in mind. GBP USD, very strong moving pair. Let me go and pull it up. I'm not going to go down this whole, well, I may end up going down the whole list. Who knows? So as you guys can see, take a quick look at this. This has some pretty nice wicks, but they are not out of control and unreasonable, although it seems like it, but it's because this is a very strong pair. But some of these candles, candles on, and you look at the candles, how they react in the trend. If you look right here, these candles in this trend, especially this upper part right here, they are much lighter than the ones that are later on down here, you know. And the one thing I will always say, if you start seeing a whole bunch of wicks on the opposite side of the trend, do be looking for a trend change. There's probably one that's going to come soon. And the reason being is because the markets is trying to communicate to people that, hey, I want to go this way. Hey, I want to go this way. Hey, I want to go this way. Of course, trader sentiment is going to continue to take it down, but there will reach a point that the market will continue to say, I want to go this way, I want to go this way, I want to go this way, and it will actually go that way. So you always want to be prepared for that, and make sure that the trades that you are taking are safe and suitable trades. This one has some pretty solid wicks right here. Not as bad until you get up in this little area over here. It's ridiculous in this area, but not as bad. But it's not something for me right now that I would actually probably trade at the moment, although we probably actually have a signal in for it. Let me get in check real quick. Nope, but we usually trade that signal, so I figured we had a signal that was in for it. So that's it for that. Let me show you guys the alt CAD. As you guys can see, this is a very strong spike backs. I would not trade a pair like this. Very strong spike backs, very strong pullbacks. It's not worth it. Be honest with you guys, man. It's not worth it. So let's go ahead and check out our alt chef. And as you guys can see, solid amount of pullbacks, but they're not unreasonable. Because this pair is a slower moving pair, you can actually get away with having a moderate stop loss and still trade in this pair. So that's what I would say on that one too as well. Now, as far as which currencies should you trade, like I told you guys in my last video, I don't fully recommend trading mainstream currencies. I just don't like them. Like, I like the idea of stuff with all USD in it or Aussie. Any pair that has the Aussie in it, I like it. I like it. Any pair that has Aussie in it, because it just moves so good. It moves so right. For some reason, it trends. Most Aussie pairs are very trendy pairs. And as you guys can see, there's just the beauty in them. Let's even look at the alt chef. We look at both of those first Aussie trades. But if you look at the alt chef and you look at the alt CAD, as you guys can see, there is a bit of sideways right here, but you do have a still trend right there. And if I was to zoom it out, you guys will be able to see that this pair is slightly trendy, not fully. And the alt CAD, as you guys can see, slightly right there. That's a very strong trend right there. So you just want to make sure that you're assessing the markets wisely. Now, like I said, the pairs I recommend, I like pairs with the Aussie in there. I also love pairs with the NZD in there, New Zealand dollar, and I love pairs with Chef in there. I try to steer clear of GBPs and US dollars unless it's the USD CAD, or GBPs unless it's the GBP Chef, and also steer clear of the Euro Alt unless it is, well, no, it's the Euro Alt, but I like to steer clear of those major pairs, and the major pairs is really Euro, British Pound, and USD. You know, outside of those, every other pair is kind of like minor. So that's all that I have for you guys today. I can't really think of anything else that I can actually give to you guys as of right now, because I do plan on making more videos kind of talking about which Forex traders, Forex pairs should you trade. But this video is more so a spur of the moment of something that I thought would be very useful for you guys. Now, another thing to note, our Nadex signals is now out. We just finished and completed our first week. It actually went fairly well. If you want to sign up for our Nadex signals, Telegram Forex signals, or our copy trading auto signals, or if you want the trend racer, which is a powerful indicator tool slash system, all you have to do is go to simpleforexoptions.net and you should be able to find out more info that is suitable for you. So I thank you guys for tuning in. I hope that you guys enjoy. I will be making another video soon because I am highly considering making a kind of teaching slash webinar about the trend racer, you know, how to trade it, when to trade it, and what time frames and pairs to actually use it for. So that's it for me today. Thank you guys for tuning in. I hope that you guys enjoy Simple Forex Options.